Hello and welcome to this special program. I'm sitting down with someone who is was regarded as one of the world's foremost equity strategists. I'm sitting down with Christopher Wood at Jefferies, and what a day to sit down with him from the sidelines of the Jefferies Investor Conference here in Gurgaon. Chris, great to have you with us here. Thank you very much for your time. I said what a day to sit down with you because we're sort of coming out of this 50 basis point rate cut from last night. What do you make of it? I know you were expecting 25, but here we've got 50.
No, I'm genuinely surprised by the size of the rate cut because it's contrary to the messaging of the Fed going into the meeting, which is that the economy is okay and the employment market is weakening, but only gradually. So, yeah, if you talked to me yesterday, I would have said 25 basis points. I think there was an article in the Wall Street Journal suggesting it might be 50 at the weekend, so that was probably the clue that they were going to go bigger. But bottom line is contrary to the messaging going in. But the key point here is what the Federal Reserve believes is the neutral rate. So my guess that is probably in the 3 to 3.5% range. So even if the US achieves the soft landing, so to speak, we're probably going to be at between 3.5 by the middle of next year. But in terms of the short term, I'm surprised I'm surprised it's 50 basis points.
Do you think it's got a political angle to it as well, with elections in November?
My guess, given the fact that whatever they might argue today is quite, anybody who can read and listen is contrary to the messaging going into the meeting. So my guess at the margin is political. Because it's pretty clear that probably the vast majority of members of the Fed would prefer Donald Trump not being elected.
I see. And
I'm sure the Republican candidate will view it as political.
But does it help at the margin?
Maybe. I'm not sure it does help. Maybe at the margin.
Okay. I want to come back to the U.S. political sort of elections season in just a bit, but we don't see 50 basis point cuts without a crisis, either very apparent or, something which they're worried about. But
there could be conspiracy theories that they know something and the economy is much weaker which is a risk of them cutting 50 basis points yesterday, actually. But my guess is they actually genuinely believe the economy is okay. So that's why I think the motivating factor is political. And there clearly are some members of the Fed who are very political. Former New York Chairman Bill Dudley has been calling aggressively for a 50 basis point rate cut. If I remember correctly, he was the guy who once wrote an article calling on the Fed to manage monetary policy in a way that could stop President Trump being re-elected in the previous election. So I think there have been quite a lot of people calling aggressively for rate cuts, saying the Fed's behind the curve. But that's not the message transmitted by the Fed chairman, Mr. Powell.
Do you believe the economy is solid?
I believe the economy is obviously the economy is okay right now, but I still believe there is a risk of a U.S. downturn because of the big lags in monetary tightening in this cycle. So if you look at a chart in my presentation I gave this week, there's a chart of M2 nominal GDP growth, which had a huge explosion back in 2020 when they printed all that money in the pandemic. And actually, while M2 growth has slowed sharply in the intervening period, while the Fed has been tightening, if you draw a trend line from 1997, the M2 to nominal GDP ratio has only just gone below the trend line, which is a long-winded way of saying that in liquidity terms, the monetary tightening is only just beginning to bite. And the labour market is weakening. All we need for the Fed to be cutting 50 basis points every meeting is one unambiguously bad labour market
data.
Yeah.
And you get another 50.
Yeah, but then the market will be discounting 50 basis points every meeting.
Okay. The Fed themselves in the dot plot is saying that there'll be two more 25 this year in 2024. At this point, that seems likely. I think it'll be more than that.
Yeah, but I don't really pay any attention to the dot plots. What's important is the data.
Okay.
I mean, the dot plots are important in the sense of what the Fed think, but I wouldn't invest any money on the dot plots.
Okay. So let's assume that it's a normal kind of an economy, maybe a little slowing at the margin, but no crisis, nothing panicky. And you have these rate cuts which have started. Let's just assume it's 50 now and then maybe another 50 through the end of the year. What does it mean for asset classes like equities?
Well, it's good news it should be good news for emerging market equities because in most emerging markets, particularly here in Asia, central banks all year had the ability, could have cut rates for their own domestic reasons based on the level of real rates and inflation. But in the vast majority of cases, they chose not to cut rates because they were worried that they might undermine their own currencies. And in the specific case of Indonesia, which has a currency, the central bank has a currency stability mandate, they actually raise rates despite very high real rates. So basically, all these central banks will now have room to cut rates, and hopefully their currencies don't get hit. So far, basically, the dollar has been in an increasingly clear weakening trend. Yeah, so that's basically good news for emerging markets.
So EMs more than US?
In my view,
in
yes.
an easing cycle?
Yeah, in my view, yes. Because in the specific case of the US, the interesting point is how resilient the US listed companies have been to the Fed tightening cycle. And that is explained by this extraordinary statistic that the net interest payments of the US non-financial corporate sector have declined sharply in this Fed tightening cycle, which is counterintuitive, but it's the reality. And that's because the big tech companies have been earning 5.5% on their cash, where they used to earn 0. And it's because the investment-grade corporate sector in America did a very good job locking in bond yields when they were low, refinancing their debt. So if the higher rates actually were positive for them on the where the lower rates will help is the SMEs, because they don't issue bonds. And that's the big surprise. SMEs in America have been paying between 9 and 10% to borrow money for the last year. And that's why I'm genuinely surprised how resilient the labor market has been. Yeah, because they employ most Americans.
What about India, Chris? I mean,
well, in the case of India, the RBI can cut rates like
later this year.
All Asian central banks can cut rates today, including the RBI. But my colleagues here, we believe the RBI is not going to be aggressively cutting. I.e., the RBI is going to behave in a different way from the Fed. And actually, the RBI in recent months has been actually counter-cyclical because they've been doing these preemptive regulatory measures as regards the banking system. And so I would assume the RBI will cut rates once before the end of the year, but I could be wrong.
Okay.
And they can cut rates because...
That's the consensus. First cut by December of this year.
I think the RBI would be coming under criticism if they haven't cut rates by the end of the year, because if you look at the level of inflation, particularly core inflation, is below the level of rates. So you have positive real rates. But obviously with the stock market at all-time highs, huge domestic flows going to the stock market, the RBI doesn't feel under massive pressure to cut rates today.
Yeah, no, absolutely. Chris, what about flows into India? Because the market here has been marching to the sort of drumbeat of local investors putting in money, and that number has sharply increased. It's about $4 billion regularly a month coming into mutual funds. It was about $2 billion a month before elections. So actually post-elections, the number has gone from $2 to $4 billion a month. I remember you were surprised when the market here, barely shrugged in response to the election.
That was a big surprise. That was a big surprise to me.
And of course, after the capital gains...
well, that's actually the biggest surprise to me was the second.
Yeah.
So after the election, clearly it was only one-day sell-off, but then I think the market's reaction was explained by the fact when I came to Delhi shortly, it was clear that everybody believed this government could last 5 years with the two minority parties. So that became more explicable to me. But I have to say I'm genuinely astonished by the resilience to the capital gains increase, which is quite material, most particularly as a week before I met many domestic institutional investors and they were not expecting the capital rate gains tax increase. So I find that...
and many of them were very vocal that markets will be hurt.
Yes, I would have been too. So we've all been completely wrong. So the only explanation is that the domestic households who are investing through these monthly installment plans have become convinced, in my view correctly, that India is a good long-term equity story and don't want to be scared out of the market. That's the only... And the big story of India this year is these domestic flows.
Yeah. But what about foreign flows? You said that easing cycle is great for EMs. India is an emerging market. Foreigners have stayed away.
But on a relative basis, if you're an EM fund manager, after this 50 basis point rate cut yesterday, the markets you're going to want to add positions to are places like Brazil, which have 11% nominal rates, 5-6% real rates, so huge potential to cut rates. Markets in Southeast Asia, like Indonesia, Philippines, which are traditionally very sensitive to lower US rates, weaker US dollar. So India is not the obvious place to put your money in today because, one, it's expensive, and two, the RBI is in no hurry to slash rates.
But haven't, well, I mean, you've been at the conference, you've been speaking with a lot of foreign investors who are here. What's the sense you get about India? Yeah, it's expensive, but it's been expensive. You could have made the same argument 3 months, 6 months, a year ago.
The people who are, the people, obviously the people here are already invested.
Right.
And so their issue, they're not too hung up on the valuation. I mean, they're all concerned about the valuation.
No, we're talking about incremental flows into the Indian market. I mean, what's the sense you get on that? I mean,
well, my sense is, yes, the problem for the foreign fund managers as a whole is that they are underweight. Based on our latest data, based on the top 30 global emerging market equity funds, they're now marginally underweight, which is not where they want to be, because most of them would agree with me that this is the best long-term story. But they're underweight. They've become underweight from a de facto standpoint. One, because they've been reluctant to pour money in because of the high valuations. Two, because this is a very important point, the neutral benchmark weighting of India has just gone up a lot, which has made them become underweight by market performance. But there's an additional issue. There are two sectors where the two sectors where foreigners have traditionally most invested in India have ironically been underperforming, i.e. IT services and banks. So in the last year, many foreign investors, particularly value-orientated investors, would have gone into the banks for the first time because they came within their valuation range. But you know, they're not the hot areas of the market. The hot areas of the market in India have been areas like industrials, infrastructure, real estate, energy, defense. These are the areas which have been driving the market. That's not the area traditional emerging market investors have been investing in.
So you don't think that foreign investors are going to come back to India in a big way?
Not in the immediate term, but the good news about this is the really positive point to take away is any major correction in India, like say 10%, in my view, will be viewed by foreigners as the opportunity they've been waiting for to add.
Are you still expecting a 10% correction?
No, I'm not. I'm just saying that's...
I mean, someone said 5 is the new 10 and maybe 2 is the new 5.
No, my view, I've got a agreed and fair long in the India portfolio. I'm not going that defensive in it.
Okay.
So, because the point is I can afford a correction. I've got very good performance. But my portfolio is heavily in energy, real estate, capex plays, but I have got the bank, so that's, I suppose, the conservative part of my portfolio.
Okay.
But the real issue for foreigners, I think the more foreigners know about India, the more specialized they are in the market, the more relaxed they are on the valuations. It's just the generalists are the more concerned. And global investors, as opposed to global emerging market investors, barely own Indian equities at all. So I'm talking about global funds.
Right. Not EM funds, but global funds.
They barely own India at all.
At all?
Yeah, literally. They don't own India.
So it's a strange kind of a position, right? I mean, because you're saying is the best long-term
story.
story.
Many global investors will agree that India is now the best story. But there's a practical issue that if you only invest in India via ADRs, you have extremely limited choices. Because of the lack of ADRs quoted offshore. Unlike in China, there are many ADRs. And the second practical issue is you want to invest in India in a sort of more real manner, you have to get FII approval. And that is a regulatory obstacle, right? That requires a real commitment. So most global funds have not got FII status.
Is that such a big issue? I mean,
yes, that's an issue. Don't underestimate that.
Yeah.
So a big fund management company could have their global emerging market fund with FII status, but their global fund may not have it. And then this capex increase, or capital gains tax, will now become will now put them off.
You know, in your note, I think the last but one note, you did mention that you put in that capital gains, and you said, well, that worries you.
Now, that personally, I don't believe in capital gains taxes on equities because people have already earned the money and they're risking. They should be encouraged to invest in equities. Now, obviously, you can deduct the money you lose. But that's just a philosophical point. So obviously the government's raising...
No, but did you mean that in the context of where India is in terms of the political...
Well, no, that is an issue because in most Asian markets, you do not pay capital gains tax. But be you domestic or foreigners. But there's another technical issue where if you're running a dedicated Indian fund, or you have to make a provision for that capital gains tax, apparently, even if you haven't sold the stock.
Okay.
See what I mean? So if you're a fund manager, you're kind of starting behind the benchmark.
Because of this?
Yes.
Okay.
So that is actually a negative, yeah. That's a negative for people trying to do dedicated Indian funds offshore.
So do you think this, I mean, India's weight has gone up, right, in the benchmarks. But do you think foreign funds will stay underweight for some time? I mean, that underweight position can actually even widen if local investors continue to put in money and the market continues to do well.
The direction of travel is foreign ownership is declining relative to domestic ownership. Fundamentally, this domestic flows are just extremely positive. And we estimate Indian households have 6% of their assets in equities. Though none of us are expecting the recent pace of flows to, by every law of logic, they should slow down. As you say, it's remarkable they've picked up since the election.
I mean, it's $4 billion a month now on a regular basis.
But from a macro standpoint, at this conference last year, we were arguing that we were in the early days of a capex cycle, but you couldn't really show data comprehensively proving that. Actually, the best evidence we were in the early days of a capex cycle a year ago, 15 months ago, was that capex stocks were rallying.
Sure.
But there wasn't the actual data. But now there's real data highlighting that the private sector capex cycle's underway.
But do you think, in a lot of ways, across sectors, I mean, stocks are already pricing a lot of this in India? I mean, capex stocks, for example.
So tactically, you would be a bit more cautious.
You would be.
Yeah. But I'm not. I've got these long-only portfolios, and I believe this. See, the last time India had a capex cycle, which I would say was like from 2002 to 2009, India massively outperformed the rest of Asia in that period. I remember it clearly. So if this capex cycle is happening, structurally, I want to remain invested in the story.
Even if they go through periods of underperformance, but eventually it'll... I mean, it's a great story.
Plus, we have the residential property story, which
you've been very bullish on.
Yeah, and we don't think there's
You did highlight that last quarter there was a bit of a slowdown, but
but that I would view all that as a pause to refresh.
Okay.
So we've got good news of if there's a weakness to the residential property story, which has been dramatic here, right? And if there's a weakness, is very much focused on what they call the high end. Which I suppose in the US, well, it depends what city you're in.
The premium end has done very well. Yeah. You're saying that perhaps sees some...
Well, what I'm saying, if you're going to criticize it, you will say it's very vulnerable because it's just the high end going up.
Okay.
But I would say, in response, well, I would have to admit that's true. I would say that's normally how property cycles work. They start with the high end and they gradually trickle down. And in that sense, rate cuts would help because if you go under 200, to use dollars, not if you go under $2,000 for a unit, you're probably going to get to levels of more rate-sensitive buyers. And so if rates go down 200 basis points here or 150 basis points, that's going to increase the number of people who can afford it.
Right. So for
I'm heard that I think I heard this week that inventory in the top 7 cities is at a 14-year low.
Yeah.
So if that's true, we can definitely keep going for another 4 years.
In terms of the cycle, in terms of real estate build-up?
Yes, because we've just entered our 4th year of an upturn.
Okay. So you're saying another 4 years?
Obviously, we take it a year as it comes, but given the fact that we had a 7-year downturn, given this multi-year inventory low, given the fact that India builds far fewer residential units today that even China,
Yeah.
given its current problems, builds.
Yeah.
You know, there's no reason to think why this suddenly blows up.
So, tell us the sectors or places that you're most bullish on now, Chris. If somebody is trying to put fresh money to work here, what would you?
I would know, like, put it in today. So I'm not taking out. I've got 19% in real estate stocks in my India portfolio.
Okay.
Now,
what else have you?
If I was starting the portfolio today, I might be a bit nervous putting 19%. But given the fact I have 19%, they've done well already.
Okay.
I'm not going to actually reduce them.
Okay.
But if I want to have a more cash, let's say I can't own cash, but I want it to be more tactically cautious, because I've got more short-term tactical considerations, and you want to own the stocks which are more neo-cash proxies, which I would say are like the banks or the consumer staples.
So, I mean, perhaps there's a little bit of underperformance. I'm not sure. Banks have valuation comfort. Consumer staples, maybe not so much.
No, but they're still, because we've got. I think we have evidence now that the rural economy is finally picking up, right? So I can see a case for adding to those tactically.
Tactically. But if you were looking at slightly beyond the very near term?
Looking beyond the near term, I'm sticking with my current portfolio.
Okay.
So the issue with
which is 19% real estate, what else?
No, it's big in capex plays and energy.
Okay.
And if any real correction in those areas, I'd be looking to add.
Okay.
Because I'm quite heavy in the banks, but the whole infrastructure story here in India, the energy story, these seem to be at the centre of the action, at the centre of the capex cycle.
Sure.
It's just very positive for an economy if you have both a residential property upturn and a private sector capex cycle going on. So the way I look at it conceptually is that the government in the last 10 years has spent a huge amount at the central government level building capex, which has been the big driver of the fiscal deficit as opposed to transfer payments.
Sure.
So that's been the enabling factor for the economy, which should give the private sector confidence to invest. And we are now, in the last year, seeing that actually happening.
Absolutely.
Yes. So whereas a year ago, talking to people in the government, they were saying why why isn't the private sector investing? So I was saying, don't worry, the private sector capex stocks are going up.
Yeah.
But obviously, if you're a government official, the stocks going up is not. You don't trust the evidence.
Absolutely. Chris, just one last point. You were cautious, right? You're telling me you're a bit cautious. We've got another round of elections, state elections coming up. Are they going to be important? Have you heard that as feedback from investors? They're watching it closely.
On the big stage, obviously we're seeing handouts, right?
Right. Across states, I mean.
Yes. So that's obviously, I mean, that's another reason to maybe add to consumer staples. Tactically, long term, that's not so great, but that just means maybe the incumbent has a chance of winning where everybody thought they were going to lose.
But would it make a difference? I mean, even if the ruling party were not so much...
that will create some negative noise.
Because, I mean, some argue that the general elections barely caused a bump, so why should this matter?
Well, I kind of agree with that.
You do?
My message, what I picked up talking to government-related people this week is, rather than passing lots of laws, the bigger focus seems to be on doing away with a lot of these regulations, which are a legacy of the what they call the license Raj. I think there's clearly a case for a bonfire of regulations to promote business.
That sounds like Elon Musk in America.
Yes.
Who wants to do the same?
Yeah, that's exactly right.
Absolutely. Chris, it's wonderful to speak with you. Thank you for sitting down with us. Appreciate your time here on CNBC-TV18. It's a pleasure.
Thank you.
Thank you.